Today we discuss the latest Consumer Price Index report, inflation, and the latest Fed decision regarding rate hikes and where we go from here. With Federal Reserve Board members teasing rate cuts in 2024, while Fed Chair Jerome Powell warns us against such a thing, we go down the rabbit hole to find out what's what. Welcome to the Recon Report. I'm Simon, an investor and licensed real estate agent. I am not a financial advisor, so please consult with your investment specialist and tax advisors before making any major financial decisions. My goal is to bring you the most relevant news and information in economics and real estate to help you better understand and navigate the housing market. Don't forget to like and subscribe to make sure you're informed and up to date on the latest news and information out of Wall Street, Main Street, and the Federal Reserve. Fed Chair Jerome Powell has just announced as of Wednesday afternoon that the Federal Reserve has decided to gift us a pause in rate hikes going into the new year. The benchmark federal funds rate will remain between 5.25% to 5.5%, with the central bank signaling the possibility of 3 quarter-point rate cuts in the second half of 2024. Now, the possibility of future rate cuts is pure conjecture, considering we were warned by Fed Chair Jerome Powell during the last press conference in November that it would be premature to conclude that the Fed has achieved a sufficiently restrictive monetary policy and that they are prepared to further hike rates if necessary. The latest Consumer Price Index report was also released earlier this week, and it's not much different than the last report, with the exception of food and energy, which are always volatile and tend to skew the data heavily in one direction or another. Inflation, excluding food and energy, as of November sits at a 4.73% year-over-year rate of change, still much higher than the target 2% annual rate needed by the central bank to reach their goal of a sufficiently restrictive monetary policy without throwing us into another recession. I use the term year-over-year rate of change when discussing the Consumer Price Index because that's how you're supposed to measure the rate of inflation. When experts or commentators measure the rate of inflation on a month-to-month basis, it's disingenuous because it tells you absolutely nothing about the economy or where it's headed, as it leads you to believe that we have inflation under control because it's such a small number. The month-over-month rate of change for inflation stands at 0.29% for the month of November. Meanwhile, the central bank is monitoring inflation on a year-over-year basis to determine if monetary policy is effective in fighting inflation. Now you know what to look for in terms of inflation. So beware when people tell you that inflation on a month-to-month basis has declined or come down to nearly 0%, because it's simply not representative of what's really happening in the market and doesn't give you any indication as to how it affects consumer prices, macroeconomic conditions, the direction of interest rates, or the housing market. At the end of the day, the Federal Reserve is a reactionary institution acting solely on data provided to them as it becomes available, with much of that data lagging by at least 1 month and up to 3 months. So we know the Federal Reserve doesn't have the data to conclude that they can cut rates well into the future as they've alluded to. But they also haven't been able to meet the 2% target inflation rate that they're chasing after. So then why are Federal Reserve Board members speculating 3 quarter-point rate cuts in the second half of 2024? What do they know that we don't? Stick with me and I'll go over some more data points, and together we're going to try and uncover what's really going on here. Since we're on the topic of Consumer Pricing Index, the latest report shows that shelter, one of the major categories of the report, peaked in March of this year at about 8.2% on a year-over-year rate of change and currently sits at 6.5% as of November, meaning rental rates have been steadily increasing since February of 2021 at the height of the housing boom, and has only recently started to come down from its peak in March of this year. It would be more accurate, however, to say rent stopped going up. I don't think it's come down in most regions, but it has definitely stopped going up. So what happens when the Federal Reserve decides not just to pause rate hikes, but to cut rates next year? What do you think that's going to do to the rental market, housing prices, and affordability? As home prices start to climb, so will rent. And it's the average renter that's going to be negatively impacted by the rising housing costs and a decline in affordability. As long as housing rates have the potential of creating greater returns in the form of equity and cash flow, investors will come piling into the market, buying up as many single-family housing units as they can just to take advantage of the increased rental rates and the gradual buildup in equity that will further boost their portfolios. Let's switch gears for a moment and drill down into a chart that compares the consumer price index, less food and energy, with the consumer price index for just the category of shelter in the United States. This by far has to be the most alarming chart I have looked at this year because it indicates that prior to or during every single recession, the rate of inflation for shelter has always overtaken inflation in the consumer price index, less food and energy. I think this is indicative of a much larger underlying economic issue, and I think the Federal Reserve knows this, which is why they're considering the possibility of 3 quarter-point rate cuts in the latter half of next year. But I don't think they'll be able to avoid the inevitable, nor do I think they'll be able to meet their 2% target rate of inflation. Taking a look at this chart, you'll notice these vertical gray bars that indicate past US recessions. Meanwhile, the red line here indicates the consumer price index for the specific category of shelter, and the blue line, however, indicates the consumer price index for all items less food and energy. You'll notice these 3 major peaks throughout history. The first one being during the 1970s recession, which according to the National Bureau of Economic Research was a mild recession following a slump in the economic activity of 1969. Notice the steep incline here and the steep declines that happen at almost every single peak and trough. The rate of inflation for shelter almost always overtakes the general rate of inflation. The same thing happens here between 1974, 1975, and again in the 1980s, in the early 80s, and then from about late 1981 to 1983. Now, if we take a closer look at a more recent chart using the same indicators between the years of 1996 till today, you're going to see something very similar to what has happened in previous recessions throughout history. And that is that the rate of inflation for shelter, meaning rental rates, severely surpasses the general rate of inflation for all items excluding food and energy. Meaning all prices have gone up, but the price of shelter in particular has gone up much faster than the price of all other items. Especially here. Now this is the alarming part right here. This section where we have the 2008 crisis, mortgage crash crisis, this section right here tells us that these high peaks in rental rates led up to, it happened before the recession. For all we know, the recession could have already started at that point, but we were just too late in noticing it. And the same thing is happening here today. Here we have this incline. Notice at no point over here in the chart do you see a gray bar indicating a recession. I, however, feel like this is a clear indication of an economic recession. Couple that with what I'm going to show you later regarding the yield curve, and it's very clear that we are in the midst of a recession, but we have not yet acknowledged it. Notice also that very steep incline heading up from 2021 until the highs at around March of 23, and more recently coming down to November. Here in November, you'll see that the rate of inflation for shelter sits at 6.52%, whereas the rate of inflation for all other items, excluding food and energy, sits at just 4.73%, which is all much higher than the 2% target rate for the Federal Reserve, understandably so. But it's that 6.5% that really worries me. because even as it comes down, it's just going to nosedive, just like we saw it nosedive after the 2008 recession, or rather during and out the other end. This is one of those indicators in which hindsight is 2020. And we don't know for certain until we have a couple more quarters of data to tell us if we're headed for a recession or already in one. Like I said before, I think we're already in one. Housing affordability is going to be the #1 biggest political issue going into the 2024 election cycle. Not only are first-time home buyers being priced out of the housing market due to sky-high home valuations, but soon renters will also be priced out of the rental market if any of these premature rate cuts come to fruition. Where are they supposed to go? What are they supposed to do? Renters need a game plan, and they need it now. If you're a first-time home buyer, but you don't quite meet the lending requirements, or you're being priced out of the market, but you still want exposure to real estate and the financial gains it has to offer, you can still do that without buying real estate, and I'm going to tell you how. You can start with a small investment in an exchange-traded fund focused on real estate investment trusts, otherwise known as REITs, such as the Vanguard Real Estate ETF, ticker symbol VNQ, the Schwab US REIT ETF, ticker symbol SCHH, or even the Real Estate Select Sector Spider Fund, ticker symbol XLRE. Each of these are high-volume ETFs that are invested in various real estate investment trusts, with total assets ranging from $5 billion all the way up to $31 billion. And so far, each of these ETFs, which have exposure to both residential and commercial real estate investment properties, have returned an average of 12% year to date. If you were to reinvest those returns, depending on how much money you've saved up and or invested, you could have enough for a down payment on your own home or an investment property for yourself in a few short years, and possibly sooner than that. While the Consumer Price Index's inflationary data is among the most important indicators, it's not the only data point the Fed needs to take into consideration. The unemployment rate, real GDP, housing statistics, US imports and exports, and the money supply, for example, are just some of the other indicators the Fed must take into account before deciding whether or not to further tighten monetary policy or cut rates. I understand the Federal Reserve wanting to pause rate hikes going into the end of the year and into 2024 so they don't add pressure to the housing market with higher mortgage rates, but why the indication for potential rate cuts when the bond market is already doing that for us? The 30-year fixed mortgage rate has already come down to just under the 7% mark for the first time since August in a weekly average, just as the 10-year Treasury bond has also come down to a 3.91% yield. Meanwhile, the 2-year Treasury bond is trading at a yield of 4.45%, higher than the 10-year. The average investor does not care about what the bond market is doing, but if you have been paying attention, you would have noticed that the yield curve has been inverted for quite some time, since July of 22. With short-term treasuries like the 3-month, 6-month, and 2-year bonds yielding a higher rate of return than the longer-term treasuries such as the 10-year, 20, or even 30-year. A clear indication that investors are cautious about the future of the economy and where it's headed. I would even say that investors are fearful of the uncertainty surrounding current and future economic conditions. A typical yield curve for a healthy economy would have higher yields for bonds with greater maturity terms and lower yielding returns for bonds with short-term maturities. In other words, investors would be willing to buy long-term bonds with the certainty and clarity of current and future economic conditions. Let me show you what a healthy yield curve is supposed to look like. All right, I have here a standard chart that depicts what a normal, a flat, and inverted yield curve look like so that you have a better understanding moving forward as I continue this presentation. You'll notice that blue line, that's a normal yield curve. Why? Because the greater the maturity rate, the higher the yield is supposed to be. You can see here it starts with the shorter maturity rates of, say, this one's in years. So this would be a 1 year and about maybe a 3-year over here. You could see that the yield, the return, ranges from 1% all the way up to about 4% on the high end. And that's what it's supposed to look like. The economy is supposed to make you want to invest in longer term treasuries because it's stable. And treasuries are a safe haven just like gold or real estate. However, an inverted yield curve, as you can see depicted by this red line here, shows you that investors would rather put their money in short-term treasuries because they simply don't know what the future holds. Here is a graph of a few yield curves from the last decade according to data provided by the US Treasury Department. So I went ahead and picked out some dates so that I can show you the difference in yield curves. The blue line would be the most recent yield curve for December of this year. This is what's happening as of today, right? You can see that this yield curve is inverted. Investors would much rather invest their money in the 1 month, 3 month, and 6 month treasuries versus, for example, the 2-year or the 10-year. Notice the 2-year yield is still higher than the 10-year, and the short-term treasuries over here on the left side are all much higher than the 2-year. What this means is investors are skeptical of the economy going into the future. The inverted yield curve has always been an accurate indicator of a recession or even a market crash. Now, if you continue looking at this graph, you'll notice that the yield curve that most similarly represents a halfway decent yield curve, in my opinion, would be the March of 2021, that orange line right there above the yellow right here. For the reason that investors can make a much higher return in the long term than they can over here in the short term. Meaning there is an incentive and they have a clear path, a clear vision of what the economy is supposed to look like in the future based on today's policies. The S&P 500, in the meantime, has returned 473% since its lows in April of 2009, up roughly 89% from April of 2020, and up an astounding 22.5% just this year, year to date. Mind you, the year is not over yet. All this despite the rate hikes. The stock market does not care about the central bank and has ignored the inversion of the yield curve, even though it is a clear indication we're headed towards a recession, as it has indicated in the past with great accuracy. Gold has been trending higher as well since October of this year and has peaked at about $2,070 per ounce, hitting a resistance level that I think could and will break through in 2024. Gold, much like US Treasuries, are a safe haven for investors looking to de-risk or hedge their portfolios. The greatest long-term hedge, however, has and always will be real estate. Much like gold, which is a finite precious metal, real estate or land is also a finite commodity. If the Fed is predicting the possibility of rate hikes in 2024, then I'm buying gold, real estate, and I'm going long volatility in the stock market, since bonds are telling me there's little clarity or certainty in the future of the economy. Regardless of the direction of the bond markets, housing markets, or the economy in general, there's always an opportunity to take advantage of. Opportunity is knocking at your door. Are you gonna sit on the sidelines and watch it pass you by? If current home values and demand are any indication of what's to come, then you want to take advantage of the next equity boom in real estate as mortgage rates come down and buyer demand takes hold of the housing market. If you want a place to hide your money outside the housing market because you believe the risk of recession is just too great, then buy gold and precious metals. If you want to be on the offensive and take advantage of the possibility of a correction in the stock market, if that's what you believe the bond market, unemployment, CPI, and Federal Reserve are alluding to, then go long volatility via call options or buy into an inverse ETF like the SQQQ. Assuming the Federal Reserve continues the pause in rate hikes, starts cutting rates in the second half of 2024, and inflation comes down further to the 3% levels, does any of this actually bode well for homeowners or the housing market? Maybe, but it depends on who you are and how you look at it. I think it's good news for investors and current homeowners, not so much for renters and first-time home buyers looking to break into this market. Investors and current homeowners will reap the reward of greater equity that comes with rising home valuations. Meanwhile, new home buyers entering the market will have to contend with tighter lending standards, sky-high home prices, and multiple offer situations with bidding wars, all of which would throw us right back into a cycle of high inflation and a need for tighter monetary policy yet again. Given all the data and all the indicators we've gone over, I think it highly unlikely for the Federal Reserve to cut rates at all next year, especially given the uncertainty surrounding the economy, affordability, and the housing market, and inflation, which still remains high. If the Federal Reserve does cut rates, it'll be because number one, 2024 is an election year. Number two, they need to bring the federal funds rate back down to a level in equilibrium with the bond market, since bond investors seem to be in control of the interest rates. And number three, it would be to rescue the economy from recession or a market crash, which would be the worst case scenario. The Federal Reserve will never preemptively raise or cut rates to impact the economy as a whole without going through all the data points and economic drivers indicating a clear path forward. And any discussion of future rate cuts is simply wishful thinking until we have the data to support it. That's all I have for you today. Check out my Instagram and Facebook page for new content and articles posted periodically by yours truly. See you next time.